Welcome back, everyone. This week we're going to talk about me selling my position in Transocean, ticker symbol RIG. The link to this publication will be in the description below if you're interested in coming over and reading it for yourself and or clicking the links that are inside the article, as I will be citing Paulo Macro in an article that Cuppy wrote. You can't negotiate desire. Negotiated desire only leads to obligated compliance. This is true in intimate relationships, and it's true in investing. You can't reason and appeal to logic in order to get a woman to love you, and you shouldn't want to in the first place. The same is true with stocks. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. In my heart of hearts, I don't want to be with Transocean. If that's too feminine for you, then let me rephrase it. My gut and instincts are telling me not to be invested in Transocean. I got with Transocean for the cheap thrills, and now I want a safer, surer bet. My party phase is over, and I now want security and predictability. I want to settle down with a less wild stock. Valaris knows how to trade a man. It doesn't matter what trade will make you the most money if you lack the courage of your conviction to stay in the trade. In other words, am I comfortable owning those stocks during a drawdown? And more importantly, will I add to that position in a drawdown? I'm looking to consolidate my portfolio. This is something that happens to me from time to time. I start looking at all the names in my portfolio and I start asking myself if I'm truly and honestly comfortable with those names and if I'm following up on them with proper due diligence in a periodic fashion. Many people have noted that you don't want to get attached to a stock. Although I agree with that sentiment, I'd like to offer another perspective. I want to invest in names that make it hard to diversify away from them. Yet, I've had wandering eyes when it comes to Transocean. Of course, my portfolio is still more along the lines of a polyamorous relationship, but how many partners does one need? Tidewater and Valaris will satisfy me just fine. I sold Transocean. With the proceeds from that sale, I redeployed the capital into Valaris. I even used a little extra cash on the sidelines to boost my position. I still think that Transocean will do well. I even think that when it's all said and done, that Transocean might outperform Valaris once higher day rates happen. However, I'm not and haven't been comfortable with Transocean for some time. This is why the last few purchases I've made in regards to the offshore sector over the last few quarters have been solely focused on buying more shares of Tidewater and Valaris. I first knew it intuitively, and then I became consciously aware of it. I thought about digging through the numbers to provide a post hoc reasoning of why I've chosen to do what I've done. But that's all it would be, post hoc reasoning. That's why I started this off with a mushy-gushy feeling type talk. My reasoning is a simple one. Stock buybacks. The parallel to coal is worth noting here. You could say that BTU and AMR have a different mix of thermal versus met coal, just as Rig and Val have a different mix in their fleet. You might note that BTU has more debt than AMR and thus allowed AMR to do more aggressive and violent share buybacks. But you could just as well note that BTU, if you haven't noticed, BTU would be Transocean in this metaphor, but you could just as well note that BTU is getting in the position of where AMR was, meaning that BTU could wildly inflect its share price in the upcoming year. This means that when it's all said and done, that BTU might appreciate as much as AMR has thus far. And don't get me started on BLDR, Builder's First Source. My failure to enter that trade will haunt me for years to come. They've put forth some massive buybacks in the last couple of years. I still believe that the time to buy these names, whether it be coal or offshore oil, was late 2020 or early 2021. But Cup of Coffee Capital began January 1st of 2023. It appears to me that the going concern, i.e. bankruptcy concern, that repricing has occurred, both for Peabody and Transocean. Now what we need is operational excellence, a cooperative macro and micro backdrop, and the use of tools to lift up the stocks, share repurchases. Oil being where it is isn't the worst, nor is it the best, at $76 roughly, for WTI, not Brent. Leading edge day rates have largely plateaued lately. That's all right. Anything that is up and to the right is probably a Ponzi scheme. Oil at $76 is really the minimum necessary for profitable wells. As the image notes below, over 90% of undeveloped reserves are estimated to be profitable at $70 to $75 a barrel. If we're at borderline profitability and taking a pause on inflecting day rates, then that means this theme might take longer to play out and reward me. Of course, it also might mean that the magnitude of inflection will be more violent than alternatively. But in the meantime, Valaris might be a safer bet. This would aid us in explaining the chart below. Transocean will outperform both to the upside, but also to the downside. If you have the equanimity and quiescence to manage such a volatile position, then congratulations. Paulo Macro, link in the description below to access the link I put in this article, and Cuppy have both noted this share repurchase phenomenon as well. In the Q4 conference call, Valaris had this to note, quote, "In the fourth quarter, we repurchased $50 million of shares, taking our full year repurchase to $200 million, representing 3 million shares or approximately 4% of the total outstanding share count." End quote. They still have another $100 million from last year's share repurchase authorization, and they just increased it by another $300 million. This totals $400 million of potential capacity to repurchase shares. Put differently, that's roughly an additional 8% of total shares outstanding. Transocean is doing none of this. Yet. It's quite simple. Let's say that Valaris buys back 10% of total shares outstanding in 2024, 2025, and 2026. But just imagine if Transocean comes out in 2026 and pulls an AMR and buys back 30% of their shares. It's the same difference. I get that. Plus, Transocean will have more operating leverage to amplify shareholder returns. The problem I have is that one's a certainty and one's a maybe, and I'm okay with taking less risk in what's already a risky sector. Am I being impatient, or am I recognizing that a bird in the hand is worth two in the bush? Will my patience cost me 2 birds down the road? Quite possibly. But I'll still have a bird, and a bird is better than no bird. In conclusion, I'm not interested in the Valaris versus Transocean debate. A rising tide lifts all boats. Actually, this article comes off pretty bullish for Transocean. We must differentiate between me being a weak hand and Transocean being the wrong play. It's the wrong play for me. I lack the courage of conviction and confidence. As far as I'm concerned, I can still participate in this sector, albeit while limiting my upside, while still having plenty of upside. And I'm okay with that. Relative performance during a drawdown is something I pay attention to. Valaris has held up quite nicely in the last roughly 6-month drawdown period that we've experienced. The real question is, why in the hell don't I own any Weatherford? Look at them on a 1-year or 3-year time frame. So that's that. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. Thank you for listening. Thank you for reading. Thank you for watching. Until next time.